Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me today is Eric Kirzner. He holds the John H. Watson Chair in Value Investing at the Rotman School of Business at University of Toronto. Eric and I are talking about bear markets, and right now we're talking about the recovery from a bear market. Eric, how long does it take for a bear market to go into the recovery phase?
Well, it happens suddenly. You don't know exactly when you're going into it, but typically a couple of years after the bear market starts, but everyone's different.
What are the signs that we're coming out of the bear? Because we have a phenomenon that investors are probably familiar with now called the bear market rally. We get a few days of wild activity, everybody gets all optimistic, and then the market quickly takes back those gains. How do we know when we're making gains for good?
Markets are actually pretty smart. Markets anticipate what is happening in the economy. You'll know that we're coming out of the bear market when the economic news is still bad, but it's not as bad as it was. When you start to see deceleration, let me give you an example. When the unemployment rate may still be rising, but it's rising at a sharply decreasing rate of increase. Okay, and it sounds awkward, but that's...
So the bad news is a little less bad.
The bad news is a little, or maybe even a lot less bad.
Okay, now let's put an investing overlay on all of this. We're in a bear market. We've gone down quite a lot. And investors are constantly told to buy low, but you don't want to buy and then watch the market fall another 10% or 20%. Based on your viewing of past bear markets, how sensible is it to buy in after huge losses have gone into the market?
Well, Rob, here's the problem that some investors have. You really have to draw a distinction between whether you can afford to do it and whether you should do it. So some investors really can't afford to be sitting with high equity exposure because maybe they'll have to go back to work, maybe they'll have to change their retirement plans if their losses are so severe. The financial plan overrides everything. Assuming that they can afford to go ahead, this would be a good time to start nibbling away. Now, it's like catching a falling knife. It can be, it can be very painful coming in. You have to have a long-term perspective.
But bottom line, bear market equals buying opportunity. Is that a fair statement?
Absolutely true.
So it's always played out that way?
Well, yes and no. 1929, it took until 1955 to recover, and we also have this lesson from Japan, where the Nikkei index in Japan hit 40,000 in January of 1989, and it's currently around 8,000. 20 years later?
I want to ask you one last question. You buy into a bear market. Describe for me the kind of patience you need to have to see your investment pay off.
You really have to have a Warren Buffett outlook. You have to believe that your horizon is almost infinite, okay? So you have to have the ability to buy and to go away, not to look at the paper every day, not to follow the markets. You have to find good quality, have a good structure to your portfolio, and wait it out.
Excellent. Thanks, Eric.